Ben, let me begin with you. There's a fairly optimistic viewpoint coming from HSBC about where we're heading through 2019. Lay it out for me.
Right, I think we've seen a sort of pain trade for many people so far. The market's rallied, people haven't been participating. I essentially think that's continued. I think we're probably a little bit more than halfway done, but I think sentiment's still too cautious. I think earnings are the next, multiples have obviously expanded here. That's how you made most of your money. I think earnings is the next thing to move up, and I think that's probably what gives us the next end of this rally. But yeah, we have about another 10% to go for the S&P 500.
You're thinking double-digit EPS outlook?
Yes. We have 10% for full year, and consensus is half that right now.
And Ben, on the point, the data that Steve just went through, both today's data and the GDP yesterday, what's your take at HSBC as to where we end the year for 2019?
We have full year GDP growth this year about 2.5%. That's obviously not as good as it was last year, but that's still an above trend growth number. And we're getting sort of 6-7% revenue growth, and we think margins are going to be very stable, and that sets you up for meaningfully more than the market is expecting in terms of earnings this year.
Rick, talk us through what's happened in the yield outlook over the last couple of days, because steady climbing from the likes of the 10-year.
Yeah, no, absolutely. It's actually even a little bit longer than the last couple of days. I'd say about the last 8 sessions, the long end has just had a little bit more horsepower, a little bit more kinetic energy. So monitoring the spread relationships between the longest maturities is always a good sign. Sometimes you can really pick up trend changes, especially considering we're in this pause period on the short end of the market with respect to the Fed, and that might be very short-lived. But the widening of that spread out to now about 40 basis points historically is a good measure to monitor when rates hit areas where they're going to reverse. Today, 3.12 and a 30-year bond, best yield close since mid-December. We're up 10 basis points there. We were up more than 10 basis points briefly in 10-year note yields when they were hovering at 276. And it's not just the U.S. Gilts, Boons, everything. Boons, as a matter of fact, more than doubled from their last low from 08 basis points. They were trading 19.20 today. And even though that's low, I think it's all significant. The other area that's giving validation to that notion is the dollar index had a powerful day today. We've talked many times, it always seems to melt around 97. We get that, but it was melting a bit under 96. Today, not only did it have a big up day, but it also recouped all the losses for the entire week.
Ben, has the Fed's pivot already been fully priced into U.S. equities?
Yeah, I think so. I think if U.S. equities are going to go higher, the catalyst needs to come from somewhere else. So I think the pivot was very important in terms of allowing valuations to expand. I think that's what got us most of the rally we've had so far. And now I think the heavy lifting, needs to be done by earnings. And we've had a good fourth quarter, and I think estimates have been cut too much. And I think we're now beginning to see them begin to move up.
Your overweight EM, is that relating to dollar outlook as well?
Not really, actually. I mean, we're looking for a pretty firm DXY. We just think that EM can do well despite that. It's the most unloved asset class globally. It's very cheap. China, which is obviously the biggest market in EM, is pretty much the most hated asset in the world. And we think that's a recipe for performance. I mean, we think Chinese GDP is actually going to be fine. The indices, the index providers are forcing you to put more money in there. And we think this China rally is going to continue and drag the rest of EM with it.
And Rick, your view on DXY, where we stand at the end of this week, a bit of softness or flatness really more than anything over the course of the week?
Yeah, I think the complexion of the curve is going to get much more tricky, the entire curve, especially with the Fed. There's a lot of discussion out there. I don't know when a pause became, written in permanent marker. I think that's a fatal mistake if investors are thinking that. At one point, maybe it was 50-50 whether an ease or a tightening was the next move. But if I had to guess, purely on the way the markets are trading now and the complexion of much of the curve outside of the long maturities, I would say the meeting you really want to pay attention to is probably the June or July meetings with respect to the market will have some time to simmer. We'll get through this earnings season and some of the humps with regard to how the market responded and acted in October and November and year end, because those data points combined with the partial shutdown of the government, we're just starting to get a complete picture. We always know that the first quarter with respect to GDP is flawed due to seasonalities, and I think Ben's right. I think the surge is going to come a little bit further down the calendar. That will substantiate the rally that we are seeing today and the stronger interest rates.